Main Street Capital just reported its second quarter 2026 earnings, and once again, the premier blue chip BDC showed why it sets the gold standard for monthly dividend growth. For Q2, Main Street delivered distributable net investment income of $1.04 per share, with GAAP net investment income coming in at 97 cents per share. Total investment income reached nearly $150 million, up 4% year over year. But the headline story this quarter wasn't just loan interest, it was a massive realized equity win. Management highlighted the successful exit of portfolio company Center Technologies, generating a huge $46.4 million realized gain. That equity co-investment strategy is what separates Main from almost every other BDC in the market. While many financial firms struggle to maintain book value during economic shifts, Main Street Capital continues to grow its net asset value. For Q2, NAV per share rose to $33.92, up 46 cents from $33.46 at the end of the first quarter. That represents a 1.4% sequential increase in pure asset value. On top of that, Main generated an annualized return on equity of 18.9% for the quarter. In plain terms, management isn't just handing out dividends. They are compounding the actual underlying value of the company while maintaining exceptional credit quality across their lower middle market borrowers. Now let's talk about every dividend investor's favorite topic, cash flow. Management declared another 30 cents per share supplemental dividend to be paid in September 2026. This marks Main's 20th consecutive quarter delivering a supplemental payout to shareholders. What makes this incredible is that a single 30-cent supplemental check is actually larger than any single regular monthly check of 26.5 cents. When you add the 30-cent supplemental payout to the 795 cents in regular monthly dividends declared for Q3, shareholders are collecting $1.95 per share in cash flow this quarter alone. To back up these constant payouts, Main Street Capital keeps a fortress balance sheet. The company closed the quarter with approximately $1.15 billion in total available liquidity, including over $1.1 billion in unused credit capacity. Their regulatory debt-to-equity ratio sits at a conservative 0.92 times, well below the industry ceiling. This low leverage and high liquidity give management massive firepower to capitalize on new, high-yielding deal opportunities in the second half of 2026 without taking on unnecessary risk. To wrap up, let me share my personal holdings in Main Street Capital. Now, if you look at my total portfolio, high-growth tech giants like NVIDIA sit at the very top. But when we talk strictly about dedicated, yield-focused dividend players, Main is my single largest holding. I hold 168.3 shares at an average cost basis of $53.57 per share, putting my total position value at $9,558.73, up 6% in unrealized gains. Every month, Main sends me around $44.60 in regular cash flow. But when that 30-cent supplemental check hits in September, it adds an extra $50.50 in a single day, bringing my Q3 total income from Main to over $184. This is why Main remains the heavy hitter in my income strategy. As always, this video is for educational purposes only and is not financial advice.